Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Thursday and final edition this week of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a sunny and kind of hazy, smokish Denver area out here in Colorado, dealing with those wildfires, obviously. Nonetheless, it is our last market day of the week, and we're going to spend some time going through a series of charts for all of you as we close things out. So today we'll get to all the major stuff. We're going to check in on our sector action, of course, and we've got a few notable stocks that were upgraded, and we need to take a look at those. So with that, I'll let you all know that we're joined by my friend Mike Fairborn there in the chat. Mike, of course, is a fellow coach, fantastic in that role, and excellent here in answering questions as well. So anything you need answers to as we work through things that I'm unable to get to, I'm of course going to keep an eye on what's going on in here in the chat. But happy to have Mike join me, and you can feel comfortable throwing your comments and questions into the chat for the duration of our show. We're going to go about 45 minutes as we usually do. And so make sure, additionally, if you're not already doing so, please follow Mike and me on X, Mike Fairborn CS, and Mike Fairborn CS and Kevin Horner CS. Great spot to find us when we're not hosting the classes for you here. And then hey, real quickly, just a wonderful football game last night that was fantastic for the team, Team USA. Great stuff. Hope you all got to see that. So with that, let's move to our disclosures here, and then we'll jump into the chart. So please remember, everything we cover for you today should be considered informational and educational exclusively. We do not make any recommendations here. What we do is provide education on technical analysis as it relates to the broad markets. We're going to look at all those charts, of course, and try to bring those concepts and strategies to the table as ideas, things that some traders may employ themselves. Whether you choose to employ them is entirely at your discretion, of course. One thing we discourage you from doing is using exclusively technical analysis to make your decisions. And what I mean by that is simply that technical analysis is a decision-making puzzle piece, just not the entirety of it, right? Price matters, but there's also a number of key factors that play into whether you should be a buyer or seller of any stock at any given moment, and we encourage you to have a plan to do just that. Okay, so our strategy, or rather our agenda for today, will remain constant. So we'll do our standard top-down review. We are going to spend a little bit more time looking at individual stocks, like I said, with some upgrades today. We also have been trying to work with an existing position on an example trade basis on the Thursday class here, just trying to give you all something a little different to consider and look to. And that position, unfortunately, from our example portfolio was eliminated in the last week. We got stopped out on it. We'll talk about that. And then we'll look to place a new example trade, something that hopefully we can continue to manage as we move forward here in this class. So with that, let's jump to the charts of the S&P 500 to get us going here. And, yesterday, unfortunately, everything that we spoke about on yesterday morning with Brent kind of remained held. That is, the downtrend line did not get violated with yesterday's price action. And certainly, if I'm going to zoom in here, one thing that we will notice is that yesterday's action was kind of a doji day, right? We had an open and a close that were pretty darn close to one another. And that's what creates that small body candle. So we have the tail below telling us that we traded lower in the day, the tail above telling us that we traded higher in the day as well. But the small body lets us know that we basically closed pretty darn close to where we opened. In fact, our open was 74.78 and change, and our close was at 74.83 and change. So within 5 points. It, of course, is green because our close was above our open. Do keep that in mind. Now, today, at this moment, marks day 3 above the 20-day moving average. We don't mind that. As trend traders, many trend traders are going to take today, if it stays above the 20-day, as maybe possible confirmation, right? If we're possibly above the 20-day for a third consecutive day, which stands out relative to the last time that we were up there. Remember, we got above it for a day on a nice little gap. Then we had that close below that high day. We made a big counter trend move, or rather a big pullback move, try to get it back into the 20, and then we failed once more. So we've got that lower highs, those lower highs built in, and we are trying to break that short-term trend. Haven't done it yet. Obviously, today's close could be that opportunity for us in the S&P. So we are ideally looking for a close above yesterday, which would give yesterday's high rather, which would give us some confidence that we've got opportunity for continuation of the longer range trend beginning back in April 8, if you remember back to when we recaptured our 50-day moving average here. So that's kind of what we're looking for in the SPX here this morning. Let's take a look at how the NASDAQ is digesting things as we kick it off today. NDX up about 0.25%. A lot of everything that we cover, you hear me say it frequently, our indices are in concert. At least the S&P and the NDX are in concert with one another. We see some similarities. A bit more volatile within the NDX, as you can see. But here we are, day 3. Potentially above the 20-day again. We would like to see that sustain into the close. But I got to point out, even though last time we were up here, we were up 5 days, or 4 out of 5 sessions were above the 20 days. So we haven't really gotten the trend reasserted so much as we've just maintained support, more or less gone sideways, a little bit more of a consolidative period than, say, a breakout period. Now, again, we are not to be surprised by such developments, at least we shouldn't. The time it takes to move aggressively to the upside is often followed by a period of consolidation. We just can't continue to run upward against a 20-period moving average for too long. When we get into the 6 to 8 week window, it tends to get a little tired and needs consolidation. It's kind of like running the race. If you're a long distance runner, you might find that after a certain point, there's a bit of a wall that comes into play, right? You kind of lose a little bit of energy. You need to be kind of coming back to a point of center, some opportunity to recharge your batteries, so to speak. Well, the same can be said about many of the indices and the way that the market acts as well. So it's important that we get these consolidations because it allows us to reset our viewpoint of the market and validate levels of price action where we should be willing to alter our viewpoint. So if we're bullish right now because we've made still higher lows, then we've got reason to stay that way. What we're looking for is something different. Right now, we don't have anything different. So a close below the 50-day would be one of those significant differences because each pullback here has not only given us higher lows, right? This is a higher low than the last ones. This one's higher than the last one. And we are testing and holding the 50-day. So, hey, one first thing could be a close below the 50-day moving average. That would be a development bulls don't want to see. Doesn't mean it would break down, but it would be a change to what we're seeing. All right. Let's look at how the Russell is handling things today. It's been one of our strongest performers. As you can see, we made an intraday high yesterday at new all-time levels, which we love that. And the Russell continues to just kind of grind its way higher in the face of the potential expectations for higher rates, higher yields. We continue to hear some hawkish commentary out of the new Fed Governor Warsh. And you know what? That does not seem, even though traders continue to position for rate cuts between now and the end of the, rate hikes between now and the end of the year, the Russell is potentially signaling one of two things. Saying either A, yeah, we don't care about rate hikes. We feel strong. We feel good. We're going to continue to push the market. Or alternatively, traders of the Russell could be saying, we don't believe that rate hikes are coming, regardless of what the position of traders is at this moment. they may not believe it, and they may still be bidding up the Russell 2000 as a result. I would have expected, as you all have heard me say, that, hey, if these yields are going to remain elevated for an extended period, that the Russell may very well struggle, but it just has not. Pullbacks to areas of support, most notably the 50-day moving average, they've been bought up. So we have to continue to believe in the trend until the trend changes. So for a lot of traders, it's the 50-day. You'll notice that we've had a few deviations below the 20, and the 20. So it's been, there's been a few instances where you've had reasons for, oh, maybe I should lighten up my positions a little bit. If you're the trader holding based on the 20-day moving average, you'd have those reasons perhaps, but it hasn't done anything to the trend. And so 20-day traders, one consideration might be that you lighten up on closes below the 20-day, little bouts of weakness, and you lighten up more potentially with closes below the 50-day, which we still haven't seen, right? Since April 8, we've been maintaining that. So as always, have that plan. Know what it is that's going to kick you out of your position or give you encouragement to maybe build a little bit of cash along the way. Let's see here. So I'm going to pull up next. We're going to look at our semiconductors. So let's take a peek at the SOX, off a little bit today, back below the 20. All right. But guys, how do you all feel about that RSI down below? Price action has been leading us higher. And we made that new high not that long ago, about 2 weeks ago, here on the 22nd. And you know what? We've still got a series of lower highs along the way in the RSI. So we've been battling a bit of a bearish divergence here for some time. And you know what? This is fine because we may be working it off. But one of the things that I'm noting more than anything is while we have this weakness with the RSI, we're not finishing our days strongly, at least not as strongly as we would like to be. What we are doing is holding an area that could be deemed support. So let's go back here. This is just about the 50 line that I'm going to draw this line in. And I just want to reiterate the knowledge of what the 50 line can be for us as traders in the midst of strong uptrends. First of all, I think it's safe to suggest that since the bottom in late March, we have seen semiconductors making an incredible move to the upside, right? Very slow, very aggressive move over a short-term period of time. So let's just define it. I think it's a little more than right around 100% if we took it from the March 30 low to our peak of just a couple of weeks ago. Yeah, about 105%, which is obviously out of character, right? So we do love a 100% return in a massive industry group like semiconductors, but we're going to need some time. So we know we have an aggressive move to the upside, a strong bullish uptrend. Therefore, one of our considerations as it relates to the RSI specifically is that we may think of oversold conditions coming into play at the 50 line rather than the 30 line, right? Remember, RSI banded between 0 and 100, those are your maximums. Overbought conditions over 70, oversold conditions below 30. But in the midst of an uptrend like this, what traders want to see is that pullbacks in the weakness of the RSI settle in between the 45-55 zone. And then that can be viewed as oversold conditions and in the midst of a pullback. So even though we've been working off this bearish divergence over time, because, again, our last peak in the RSI was back in late April. We have basically been rallying 2+ months with that RSI giving you a divergence. And all that's done is be providing choppiness to the SOX. It hasn't broken the SOX yet, right? We've made higher highs. We have higher lows. Even if we were to test the 50-period moving average, it would still be, in all likelihood, a higher high, right? Let me try and get my draw tool back here. Let's just throw a little arrow on this for y'all. There we go. All right, so right there's the 50, right? So even if this was a pullback low, it would have been higher than this low, which was higher than this low. And so what we've got still remains in line with expectations. Higher highs, higher lows. Change of that would be the significant development. Right now, that's not what's playing out, right? We had a weak open, and we'll see if that holds today, weekly below the 20-day. But I could say there does appear to be a little bit of horizontal support at these lows. And if I draw that line in and then transition to, say, the hourly here, let's see. Now, there's all my arrows. Let's back this off a minute. Go to about the last 90 days. Yeah, so here is kind of what I'm looking at. This is your extended low, and then intra-period lows somewhere in this vicinity is what you're looking for short-term support. All right, and so that's right in the ballpark of, say, 13,000 or so, 13,100 on the SOX, and holding this would be favorable shorter term, right? So again, uptrend. Try not to over-evaluate our price action. We like what we see from semis. Even a pullback to the 50-day could be constructive for us along the way. All right. Bill, you're right. Let's take a look at what's going on with oil next, because oil continues to retreat, and that's the kind of a shock. Obviously, that's a win for the broader markets. It is a disinflationary viewpoint. Let's talk about it. Let's look at the crude symbol here. We're going to use the /CL. Not that we are promoting in any way the futures symbols, but we're using the futures symbol so that we can get a clear picture on price. The big thing here, of course, is the substantial pullback in oil, particularly the speed with which it has done so since breaking down out of this consolidative huge triangle. Broke down at the 20, rallied into the 20-day, and failed, and then it's been aggressively lower. So we did a complete round trip back to late February, and we're still in that support zone. But oil continued lower here this morning. Now it is in true oversold conditions, but remember, oversold RSI does not imply, nor should we as traders infer that it means it has to bounce. A bounce may be more likely than lower immediately, but that doesn't mean it has to happen. So if you're the trader who is waiting to maybe take a position on the bullish side of oil in what would be now a counter trend move, by the way, you'll notice we've continued to make new lows, and yet we have not even come close to a day where we closed above the high of our low day, all the way back to here. And this is fine, right? This was your hold move, and then we rallied for 2 more days. But what did we do? We rallied into resistance, right? So the trend prevailed as it related to the oil breakdown, at least. So there may be, again, a counter trend trade for those traders willing to take on some of that risk. But I thought that was a notable signal here again, because the longer that oil persists under that $70 level, or maybe even more importantly, 74, it just puts us back into a window where we're more likely to see inflation kind of start to moderate a little bit. It's been hot, it's been difficult, but the timing of this couldn't be better, given our move into the deeper parts of the summer, of course. And this is absolutely, travel season, as everybody is likely aware. So, the oil move has been helpful for us broadly. Now, while we're looking at oil, I also thought we could take a peek at Bitcoin one more time. Bitcoin made a pretty big move here. And when I say big, I want to talk about it from the standpoint of those last lows and what we're getting out of the RSI. So I am zoomed in a little bit here. So let's Let's increase our view on the RSI a little because we have recently taken us from that way oversold condition, which was as low as about 19 on the oversold line, or rather below the oversold of 30 on the RSI. And the thing that stands out here, everyone, is the price made that lower low, but we have the divergence with the RSI. Now, we know that we can't take bullish divergences as outright buy this position, right? We know better than that. But we can say that it is giving an inkling that perhaps the low is in. The inkling might be that you've shaken out enough of the traders who were worried down here. You've had a couple of breaks below 60, and so we've dabbled beneath it. It's been as low as about 57,700. But look at that RSI. Not again. Again, now we're trading at a level that okay, so we look at where we are in price. Okay, the last time the RSI was at this level, the price was 67,000, right? And now we are through that with the RSI, and the price is only at 62. So we're about 5,000 shy of where we were last time. So what we see is an improving signal from at least the relative strength index that things are better than they were, regardless of what we're seeing in price. Okay, so Bitcoin is that when Bitcoin's moving favorably, the risk on feelings of the market kind of permeate things, right? If traders are willing to take risk with Bitcoin, it feels like they're willing to take risk elsewhere, and some traders use it as a proxy of that risk, feeling confident to deploy money elsewhere in the market and maybe take on a little more risk. So, not to say that that's there's not really a lot of that's more anecdotal in nature is what I should say, because that does not happen, because as you know, what is Bitcoin tracking? It's not, right? It's on its own. So all right, let's talk a little bit about some of the sector movements we're getting here. This morning I noted that yesterday's moves in the financials were really significant for us on the chart. So let's take a look at the financial space. I had drawn in this pennant formation, and we broke that aggressively yesterday, didn't we? That's exactly what bulls wanted to see, was a candle that was completely outside of the downtrend line from the flag or pennant, and we absolutely did that. So many traders are very pleased with this action, and this could be, moving into bullish conditions as well, or getting RSI into oversold conditions also. So financials, a space that's looking stronger, and it's not alone. Financials and healthcare have been really nice developments here. Here's healthcare breaking higher today out of a very quick bull flag, right? That was all of about 3 days of a flag, and we're at pretty high levels here. In fact, let's see does this look as much of a, yeah, so, you could say that you could see that the action in here, fairly basic, right? Just kind of something like that. And this has been terrific. We don't mind seeing healthcare make this kind of a move. So another space for initial leadership, everyone. Remember, I know how hard it is to get away from technology sometimes, but you might have heard that idiom of the market, that there's a bull market somewhere all the time. That is so true. And traders, we need to try and break our habits a little bit where we can. It's not to suggest that technology isn't going to do well for traders going forward, but we have new leadership from sectors that can, at least in the shorter term, and it can give you alternative areas of the market. Often we hear traders and investors talking about diversification as it relates to their broader, longer term portfolios, but don't hesitate to be diversified in your trading approach too. There might only be 3, 4, 5 sectors that are moving in a way that gives you confidence, and you might want to play in those 3, 4, 5 different sectors. You don't necessarily need to have trades in all of those, or even especially not all 11 sectors of the market. But when you have individual trades within various sectors as opposed to just one or two sectors, you're probably going to find your portfolio's day-to-day machinations to be a little bit more manageable for most of us. Now, that doesn't mean that's the case for all of us. We're all different as traders, of course, but I thought it was notable and a good reminder that you can still diversify your trading a little bit and get less volatility on a day-to-day basis from your trades and from your portfolio. So something else to keep in mind. All right, yesterday we had a good move in communications, which is getting a little bit of a breather here, but it's doing so back above the 20-day. And traders, this is kind of what some are unfamiliar with, is that Harami day. Let's talk about that quickly here. I'm just going to zoom in to our most recent move. We have a move above the 20-day for the first time since we broke it, right? We broke down back here in mid-May. We've got a downtrend line. If we want to be very specific, we could say that we've rallied into the downtrend line. We don't have to be terribly tight to our manually drawn trend lines necessarily, but the fact that we've got a day where we're pausing at the moment as we've held the 20-day, this is okay. So, remember that as we move to a new area of potential support, it might just be as important that we hold the 20 as opposed to continuing to rally higher immediately. If we just go sideways here and hold this level above the 20-day, some traders are going to take that as their positive view, right? And they're going to look to manage risk utilizing the 20-day now. But this, of course, had a really big pop in Meta yesterday, and that certainly carried the space. Let us take another look at, let's see, energy's up today, and materials are up today. Let us check on the other one that's a little defensive in nature. Let's look at those staples, which continue to be a bit more in consolidation still, right? Holding on to the 200, but you can see we've really not gotten trend action in staples. So when we've looked, so by nature, traders are going to fall into defensive positioning in the staple space commonly, but it's not been the space that we've seen traders falling into of late. Much more likely financials and healthcare. Let's look at our MarketWatch page for a bit of a brief breakdown. One of the things that caught my attention here this morning when we look at this, industrials and leadership. Okay, this is year-to-date changes now, everybody. Energy number 2 at 18.5, and then tech at 18, materials, real estate, staples. We've got 10 out of our 11 sectors are positive on a year-to-date basis. And now what's interesting about all that, to me at least, is that we've gone through a couple cycles this year already, right? Energy was hot to start the year, and for the first 3.5, 4 months, energy was up like 40%, given back a fair bit of it remains hot, remains elevated at least on a year-to-date basis. So we can get these significant swings and still maintain positivity on an annualized basis, right? So I thought that was notable because even if you were the trader who's just been long energy or had exposure to energy on a year-to-date basis, even as we've given that back, it has not probably been as terrible to your portfolio simply because we've been buoyed in other areas, right? Big reminder for why diversification within sector classes can work for the longer term investor. I did want to look at industrials. Let's take a peek there as well. Yeah, look at that move, everybody. Industrials had a breakout and a quick throwback test before moving higher. 20 period caught up with price action. Perhaps the 20 period will be the trend following portion for industrials here. That seemed like a notable move. Okay, what do you say we get to some individual stocks, everybody? We had a trade run in this as an example trade in this class. It was in Synopsys. Unfortunately, that got stopped out. So let's just go ahead and take a peek at SNPS. All right, so we had been buyers back in this space here. We'd had a stock that had broken higher, thrown back to support, what we hoped was support, right around the 200-day moving average. And I'm now reminded, and of course this is often the case, we get reminded by price action about what can occur, but I'm reminded that downsloping 200 period moving averages are difficult to use as support because we have the reason we have a downslope is due to recent price action, right? And yes, we got above the 200 period, but we met clear resistance up there at 535, and then we used that really as our entrance concept. Hey, we've got a possible new uptrend developing here. Well, that just didn't hold. So we got in at about 489, and we had a stop order below the 200 period by the amount of the average true range. We held it for a lot of the time. In fact, our stop was somewhere in this vicinity. We were testing it here for a while. We had 3 days in a row where our lows were just barely above our stop exit, and then we got taken out earlier this week or this last few days, and these lows took us out. Now, this is okay because I'll point out, hide those trade details. Look, basically we have been below the 20 period now since here. Or really, I guess, since we took it out. May 27. Yeah, we closed above it technically right here, but we've been below it since, right? So we basically have spent the entire month of June below the 20 period. And that's not a great short-term trend development. So we got booted out. Doesn't mean there might not be another position there, another opportunity down the road, but that's what happened with the Synopsys trade, unfortunately. I wanted to discuss some of those upgrades that we got today. 3 companies that you're probably familiar with. Let's talk about them. One of them was Palantir today. D.A. Davidson upgrading Palantir to to buy from neutral with a new target at 175. Prior target was 165. They state that the company has grown into its valuation as its profits are up significantly and the stock's multiple has come in. This provides investors, quote, with a gift just in time for the U.S. 250th birthday, end quote, according to analysts at D.A. Davidson. They believe Palantir has several competitive advantages over the other software companies, and they are becoming now more pronounced with due to AI specifically. Let's see. All right, so as it relates to Palantir, everybody, we had an interesting move here, right? Because we've taken out that 125 zone that was prior support. We traded below it for about a week and a half, but this bounce has been pretty significant here. I wanted to, let me see, I have somehow lost my volume, so let's make sure I add back volume here. All right, and then let's add in average volume. This is the 50 period average volume, everybody, and we like to see if, okay, so this is a somewhat positive development, right? Because volume in the last week, we've had 2 good days where the volume spikes through the 50 period moving average, which we could use to define it as institutional buying at these levels. So the stock is up quite nice. I mean, we were down as low as 107. Here today, we're up 25 points from there. Had a great move, 132.5, and we're rolling into the 50 period moving average there. Could that be resistance? Absolutely it could. So some traders would perhaps, depending on your process, look to maybe take some off at the 50 period, maybe set up a belief that if we move through the 50 period, they'll use that as reasoning to add to their trade. If you're a buyer back here, though, and suddenly up 25% at an area that could be resistance, it wouldn't surprise me at all to see some profit taking as we come into that level. So make note of what is about 135 ballpark there at the 50-day moving average. We moved through it, the 20-day today with conviction, of course, having basically just kept the trend running. So this is a nice development on Palantir here specifically. Good question, Barbara. Let's talk about it. 50 period average volume. Some traders will use the 20 period average, but the main thought here is I'm trying to get a snapshot of the majority volume you get. What we want to see are candlesticks that are in that are bigger than the days of our average, right? Or we're getting volume bigger than the 50-day average. The 20-day average can be helpful for some shorter term traders, but what I'm learning with the 50-day is what is the most common volume profile we see on a day-to-day basis. And then when we exceed, well, then we know we've got so-called smart money buying potentially. And the reason we know that, or the reason we say that at least, is that it's very uncommon for the retail trader to be capable of generating the amount of volume necessary to take us through the 50-day average of volume. So it's just an incorporation of a wider swath in time, in this case 10 weeks as opposed to say just 4 weeks. So you're getting a little bit more of a true understanding of volume by using the 50-day. You could certainly use the 20, but what I think of it as, when we get spikes that are greater than the 50-day, it's a little bit more instructive than, say, spikes that are greater than the 20-day. Hope that was helpful, Barbara. Let's see. I did see that comment. Yeah, monitoring individual trades on a one-day-a-week basis probably is not the easiest way to manage our individual positions. You're right about that. However, bear in mind, when we build in an exit strategy, both above and below the market, we at least have a relatively well-defined risk process. When we know that while we can sell at our limits on the upside, our downside sales are with stop orders not going to be held to any specific price unless we incorporate the stop limit trade in lieu of just the traditional stop. But we do that. We build in that process, right? And so we've got a comfort zone. And so managing a trade on a one-day-a-week basis is less than ideal. It's true, but for our purposes, I don't want to make changes midweek. I want to make changes with all of you here. So if we're looking at individual trades, that's what we're going to do, is we're going to make those changes here as opposed to outside of class. I don't want to do that. Okay, now interestingly today, in the software space, we got an upgrade on Adobe. Adobe's chart with what we just saw in Palantir looks kind of similar, doesn't it? Back above the 20-day today, and it's kind of significant because it did take out a gap level here. So maybe some traders are going to be a little bit enthused by the break of the 20-day, but Adobe, everyone, has just been on a real difficult window. Our friend Barb Armstrong would call it the struggle bus. They, of course, had highs in the most recent 2 years up in the neighborhood of 580, and we're down here at 217. So the stock has been under a lot of pressure, below the 200-day with conviction all the way back to late 24. So basically, we're looking at least 18 months here. Now, Adobe today was upgraded at HSBC. They upgraded to buy from hold, a new target at 308, up from 282, which is really interesting considering they could have left the target alone and still been targeting the 200 period moving average up there. But that seems interesting that they've made that adjustment at least. The firm upgraded the shares after reevaluating the company's risk that is associated with its AI-powered competitors. They remain strong. Adobe maintains strong revenue growth, even though its AI design tools were some of the very first AI applications that were available in the marketplace. HSBC believes that the company's platform has proved to be sticky for its users due to workflow familiarity and new AI-powered features that are recently being embedded. So improvement, right? And you're right, Barbara, another validation essentially that we've seen real lower lows in RSI. You got to go back to January when the RSI bottomed out, and yet 6 months later we're having a higher low in the RSI as price made a lower low. So we do have that divergence that might get some traders interested. You have an upgrade that might get some traders interested. But let me remind you, we are looking at a significant and healthy downtrend. longs on this position at this moment are going to be counter trend. And counter trend trading is not for everyone. So if you are interested in counter trend trading, just be as consistent in your process as you can. And remember that in counter trend scenarios, it is not at all uncommon for stocks that are aggressively moving to stop aggressively moving as they find resistance. All right, and resistance initially might be where my crosshairs resides here, in the neighborhood of 230 to 235, and coincident with the 50-period moving average. If it can manage to get through there, we see that we had another peak that was in this vicinity, and of course this level takes us to that prior price level that that HSBC had set for it at 282 prior highs, right? So that could be resistance as well, right? And then a brief upgrade with very few notes came from Wolf Research, and that was on Chevron. And Chevron's chart doesn't look fantastic. It broke the 200-period moving average last week, and it's continued lower. The significant move was when it took out and made a gap move right here through these lows. That was kind of a pretty negative heads up. It's not even been tracking the 20 period. Looks like tracking the 10 period a little more closely. So that might be a notable development here in Chevron below the 200. A shift above the 10-day might be significant in the short run here. They were upgraded, though, to outperform from peer perform and a target at 210. And then I'm just going to add in the blanket reminder that price targets, whether it's an analyst target or our measured move calculations, they're just never a guarantee to be achieved. And it's important that we keep that in mind. So I wanted to make sure we touched on Chevron there for you here this morning as well. All right, everybody, I think we're going to wrap it up there. Didn't get to a new example, but there's going to be more classes from me here coming forward, of course. So we'll look to incorporate potentially a new example trade as we head toward next week. Today, you've got more to come from us. It is a full market day today, of course. So keep that in mind. We do get the holiday tomorrow. So no classes tomorrow, no market tomorrow. My hope is that you all spend your time enjoying company, enjoying friends, enjoying family, taking a rest, and celebrating the 250 years of our country. I hope you all have a fantastic weekend. A big thank you to Mike Fairborn there in the chat. Our next class will be long verticals and diagonals. That comes up with Connie Hill at the 11 a.m. Eastern hour. So if you're interested there, make sure that's on your calendar. Make sure to be following Mike and me on X. And if our conversation today was at all helpful for you, go ahead and hit that thumbs up button down below. I'll get this one reviewed with my compliance team and get this into the archive for you as quickly thereafter as we can. So, I just want to reiterate my appreciation for all of you who are here frequently and join us 4 days a week for Trader Talk. I love hosting this class. I love seeing your names and avatars there in the chat, and I love hearing from you as well. So if you reach out on X, I do try to reply. And again, I hope you all have a really fantastic long weekend. I, of course, look forward to catching up with you all again real soon.